Welcome back. Sunil Singhania is Chief Investment Officer, Equity Investments at Reliance Mutual Fund, and he's now joining in to discuss the CPSE ETF, which is going to hit the market soon. Sunil, good morning. Great to have you with us here. Thanks very much. So let's just start with a basic question. How would you answer the question? An investor might ask, why should I invest in this fund?
So I think very clearly, the underlying stocks of which this ETF comprises of are very large, stable companies. They are market leaders in their respective fields. What we have also seen over the last, 3-4 years, maybe in the last 2 years in particular, is that a lot of these public sector enterprises have transformed themselves into better corporate governance, better profitability, more visible, stable and forecastable earnings. And I think, the huge dividend yield and also the 5% upfront discount which every investor is, entitled to, I think it turns out to be one of the better products.
Sunil, firstly, afternoon, and thank you very much for joining in. The CPSE ETF CAGR has been quite strong, 17% plus versus the Nifty, which is at around 8% plus. Your sense, and this is since the inception, your sense in terms of what the return rate could possibly be, say if you're assuming 1, 2 and maybe 3 years?
So I don't know what is going to happen in the future, but what I can give you is some data points. The PE of this basket is almost half that of the Nifty right now. It's trading at an 11.5 times PE versus almost the 21 times PE for the Nifty on a trailing basis. The price to book value is 1/3 that of Nifty. And at the same time, the ROE, which is a reflection of the efficiency of a company, is almost 30% higher than that of the Nifty companies. So I think the companies are highly profitable, they are generating higher return on capital, and they are trading at almost 50% discount to the Nifty in terms of their PE ratio. Also, the dividend yield is almost 4% for this basket. So I think there is a probability of maybe the discount to Nifty as far as the PE ratio is concerned coming down. And we are very optimistic that with a low, very, very low expense ratio, I think this product has a potential of beating the Nifty over the next 1 to 3 years.
Sunil, usually, so we are talking about this fund in particular, this offering in particular, but investors also, it's always relative for investors. I mean, okay, should I put money in this or something else? And something else could be an equity diversified scheme, could be a sectoral fund, infrastructure, banking, etc., etc. But those are very different. This essentially is taking a bet on the government, right? Which is essentially the promoter of these companies. Taking a bet that the promoter, I mean, that is a common thread through all these companies, is going to do very, very well, is going to allocate capital very well in the future. Would you agree with that assessment?
So I think we have to look at the history, and then, you can basically make some assumptions as far as the future is concerned. So yes, the principal shareholder is the government of India. However, over the last 2-3 years, we have seen the government having a sort of off-the-hands approach towards managing its public sector enterprises. The other thing we have to also see is that whether it's the oil marketing companies who have got absolute freedom in terms of their pricing with almost zero, subsidy burden, or the energy companies and the coal companies which have started to get pricing power, and the engineering companies which are getting benefit of the huge capex which most of these government companies are getting into. Also, as I mentioned earlier, the ROEs have been consistently rising, the profitability has been consistently rising. So there is no hesitation in us to believe that these companies are now starting to move in the trajectory of better managed, and to some extent even following the trajectory of some of the private sector companies. Also, as I mentioned earlier, because of the risk which you mentioned, already the companies are trading at a 50% discount to Nifty, which to our rationale is slightly negative. In our active portfolios also, we have a decent exposure to government companies. And the theme for us is the same, as efficiency is coming into the country, as we are seeing a scenario where, inefficiencies in governance, inefficiencies in the way you're working as far as the public sector is concerned is coming down. Even these companies will be benefited out of that. And we might see a better capital allocation, a much more focus on efficiency, which is measured in financial terms by the ROEs, higher dividend payout, which has already been announced by quite a few companies, and also very investor-friendly steps like giving bonuses and stock splits. I think all these are signs that we are moving into a scenario where the historical discount which we have been giving to these companies are set to contract. And with the underlying scenario, both from an oil perspective as well as the commodity perspective also improving, I think the profitability of some of these companies can surprise positively on the upside. So I think there are some really good 2-3 years ahead for these companies.
Okay, all right, Sunil, we have to leave it on that note. But